Testing. Let me see. Testing. Good evening. Goeienaand. Good evening, Mr. Swanepoel. Good evening. I hope you can hear and see. Good evening to everybody joining. I hope you can hear. I'm just doing the tests. Hello. Just a test, another test. Can anybody hear me? Kan julle hoor? Good evening. Hallo, goeienaand julle. Yes, ons kan u hoor. Baie dankie. So ek is Afrikaans, maar ek gaan dit in Engels hou vanaand, want hier gaan dalk mense wees wat nou nie Afrikaans verstaan nie, maar ek beoog om een in Afrikaans te doen in die nabye toekoms. Maar julle mag vra in Afrikaans en ek sal hulle beantwoord soos ons aangaan. Ek sal binnekort begin. Baie dankie aan meneer Swanepoel dat jy nou laat weet dat julle my kan hoor en ek glo julle kan die skerm ook sien. Hallo Martelien, hoop dit gaan goed. Ek gaan dit nog so 'n minuut gee, just a minute, and then I'll go ahead and start. Please feel free, you can ask questions in the chat box. and I will stay until all questions have been answered. Okay, let's start. Please stop, or if you cannot hear me at any time, if you cannot see the screen, feel free to let me know in the chat box or try to get my attention. But here we go. So tonight's session is it's a GEPF Masterclass. So my name is Rowen, for those of you who don't know, and I've received a lot of questions from clients in regards to the GEPF. I am keeping this event tonight in English, but I am looking to have one in Afrikaans soon. But I want to reach as many people as possible, and this is why tonight's session is going to be in English. You are welcome to ask any question in Afrikaans, and I will answer it accordingly because I am Afrikaans. So just a disclaimer before we start, this is not going to be financial advice because I can only give you advice when I take your personal situation into account. So it's important that I want you to understand the principles of tonight because it won't necessarily be your situation, because we need to do a calculation in order to see if your situation is the same as the example that I will be using tonight. So just some outline before we start. I'm going to start with a bit of my background, not too long, and then I'm going to go into the meat, the GEPF. Is it better to retire or to resign? I'm also going to touch on how to leave a legacy by paying no tax. And also a question that I've received frequently is leave and tax on leave, and how is it calculated and how one should plan accordingly. And I'm going to leave part 4 for any questions that you may have, and I will answer, and I will stay here until all the questions are answered. So just some background. My name is Rowen, and I'm a financial advisor, and I have more than 10 years of experience as a financial advisor. So the reason why I thought I should have this webinar tonight is because firstly, it hits close to home in the sense that my parents and grandparents were members of the GEPF, and I could use them as a reference and as experience in order to build not only my knowledge, but in order to give them advice accordingly. And I think that is one of the reasons why I'm so passionate about the GEPF. So I, as a financial advisor, I normally tell them that I help people make the right decision when it comes to their GEPF options. So that's me in a nutshell. And I can guarantee you, if you apply what I teach today, you will not have any financial worry or uncertainty that you won't have enough in the future. Another important notice is all these calculations, I urge you to please speak to a financial advisor first before you act, because once you made a decision regarding your retirement and you sent away the documents, that decision is final and it cannot be changed. So it's important to understand and know the outcomes beforehand, before you make that decision. So please speak to somebody. It doesn't have to be me, but speak to someone that you can trust, that can show you the calculations in order for you to know what the options are and what would be best in your situation. For those of you who don't know, the GEPF is the Government Employees Pension Fund. And here's some of the logos and departments that are part of the Government Employees Pension Fund. So in South Africa, most government employees are members of the GEPF, but not all. Now, when you start off and when you join, you need to complete the following documentation. You need to complete a nomination of beneficiaries form. You need to complete a personal details form, and you need to importantly register your spouse or your life partner, and you also need to register your children. But if you want to avoid any delays in payments, it's important for you to let the GEPF know immediately to avoid those delays in payments. You need to let them know if you are married or if you got married, if you were divorced or got divorced, if a child was born or if you lost a child, if your address changes, if your contact number, if your email changes. You have to nominate your beneficiaries and you have to nominate a life partner. So you have to complete a life partner application, which I will get into a bit later. Now the GEPF is what we call a defined benefit fund. Now there's two funds, and I want to explain them to you so that you understand not only your benefits better, but also the defined contribution fund better. So there's two types of pension funds. You get a defined benefit fund, which the GEPF is one of those. Now, your values in the name, it explains what a defined benefit fund is. So your benefits, or you can say your values, are determined by a formula. Now, this formula is defined by the rules of the fund. In other words, your benefits are guaranteed and defined by the rules. That's why it's a defined benefit fund. Your benefits are defined in the rules of the fund. For example, you have a death benefit, and those benefits are guaranteed or defined by the fund, and then you have a retirement benefit that is defined by the fund. The different option or the different fund, a defined contribution fund, is a fund where you contribute your monthly contributions, or it's the same as the defined benefit fund. Your defined contribution fund is in the name. Now, how much you contribute is defined in the fund, not the benefit or the value that you received at death or retirement, but how much you contribute is defined. Now, these contributions, these monthly contributions in a defined contribution fund will grow based on the investment performance. This is normally private business funds. GEPF is the defined benefit fund. Now, because it is a defined benefit, their payouts or values or benefits are determined by a calculation. Now, for GEPF members to know how much pension they receive, for instance, they have to know the following, or they take into account in this formula the following. They take into account your years of service, of course, your years of pensionable service. Also, it includes if you have purchased any years. It also takes into account your average salary over the last 2 years, and it will take into account your exit age and your type of exit. Now, these four things will be used in a formula to determine your retirement, resignation, or death benefit because it is defined within this formula. So here I have an example of Jane Doe. Is it better for her to retire or is it better for her to resign? Now, because I can do the calculation, if I have these figures, if I have your pensionable service, if I have your salary, if I have your exit age and the type of exit, I can determine the retirement benefit. So I have Jane Doe, who has a annual salary of 350,000 Rand, and she has 30 years service, but she did not purchase any additional years. So with that information, I can calculate. Now, the process that I want you to follow tonight, I'm first going to calculate Jane's retirement benefit, right? Within the GEPF, I'm going to calculate, and I'm going to use her as an example, what her retirement benefit will look like. Then I'm going to calculate a resignation benefit because I want to use this resignation benefit to determine what the income will be if she moved from the retirement to an approved fund. So then we are going to compare. We're going to compare the GEPF income with the income of a approved insurer or approved fund. Now, Jane's retirement benefit, according to the calculation, Jane wants to retire at age 60, and her lump sum benefit, which means her once-off payment, will be 705,600, and her income benefit will be 15,939 rand. This income of 15,900 is guaranteed for life, right? So this is the retirement benefit of Jane Doe. And I want you to remember, but I'll get back to these figures. So we need to remember, especially the income that she'll receive is 15,900. Her resignation benefit is 2.4 million. So if she decided to resign, her resignation benefit, according to the formula, is 2.4 million rand. Now, with your resignation benefit, you have two options. You can either transfer it to an approved retirement fund, or you can take the total benefit and you can pay that benefit in cash into your bank account. There is tax involved, and I will get to that a bit later. But those are the two options if you take your resignation benefit. So if Jane Doe takes that resignation benefit and she invests or transfers it to an approved retirement fund, she will need to adhere to the rules of that retirement fund. Now, the rules are as follows. 1/3 is the maximum that she'll be able to take as a lump sum from the 2.4 million. The remainder, she can take less, but the remainder has to be invested for an income. Now, the rules of the living annuity or of this retirement fund say that the least that you can, or the minimum that you can withdraw is 2.5%, and the maximum that you can withdraw is 17.5%. So those are the rules within this retirement fund. Now, if we do some calculations, if we transfer that money to a approved insurer, we have 2.4 million, and we are allowed one maximum of 1/3, and that equals 810,000 rand. If we deduct the 810,000 rand from our 2.4 million, then we are left with 1.6 million, and this is the remainder that we need to use to provide us with an income or a pension. Now, as I stated previously, the minimum that Jane can withdraw is 2.5%. Per year, that means it's 40,000 rand, but per month, it's only 3,300 rand that she can receive as an income minimum. Now, Jane won't be able to live off the 3,300 rand. If we look at the maximum, according to the rules, she is able to get 17.5%, and that equals 23,652 rand. And that's 17.5% of the 1.6 million. Now, my advice would be, and a good rule of thumb would be, if you can take 4% of any capital that you have, then that capital will survive and outlive yourself. Right? If you take more than that, then there's risk involved. So if we compare what the GPF provides, so the GPF gives us, if you can remember, the GPF gives us 15,939 rand. Sorry, say 15,900. And if we compare 15,900 rand equals almost 12% of your capital that you need to withdraw to equal what the GPF provides and what you will receive from a insurer. Now let's take a look, and let's look into this a bit deeper. So this means when you invest your money and you withdraw a certain percentage for an income, say 10%, the only way that you can keep your capital at 1.6 million is to also receive a growth of 10%. Right? Stated otherwise, if you eat 10 apples, or if you take 10 apples of 1.6, you need to put 10 back in order to keep your 1.6 million at that 1.6 million. Now, the problem comes, and the risk that a member has, if he is withdrawing 17.5%, but the growth on this fund is only 5%, then your capital will tend to go to zero. Your capital will deplete because you are withdrawing 17.5 and it's only growing with 5%. Or stated otherwise, you're eating 17 apples, but you only giving back or putting back 5 apples. Remember, and 17.5 is the most that she can receive. Now, although this income looks, we're happy to receive this income, there's an impact or consequence of taking this income and your investment not performing as you wish. So that is the risk to the member. Furthermore, you have to remember that when you are investing, there's risk involved, and there is a possibility of your investment having negative growth. So over a period of 5 years, from 2015 to 2020, these funds grew negatively, which means they lost money over that 5-year period. Now just think what would happen if your investment, if your retirement 1.6 million, instead of had a growth of 5%, had a loss of -5, -10%. So there's a risk involved in investing your money in any investment, and you need to take these into account when you make your decision when you are retiring. But there's some more things that we lose when we resign from the GEPF. You will lose your medical aid subsidy. You will lose leave days. You will lose your funeral cover. You will lose all the increases because you have to choose your increase if you take a percentage. You will lose a spouse's pension and your child's pension. So these are all the extras you'll need to cover for when you resign from the GEPF. You need to make provision. I did not, in that calculation, make provision for my medical aid. I did not include that I'm losing leave days. I did not use some of that salary to purchase funeral cover because this is all the things extra that you'll lose if you decide to resign. Now, option 2 with a cash resignation is when you take that full amount in cash in your bank account. If you do that, and if you don't transfer it to an approved fund, or if you don't use the GEPF, the tax that you'll pay will be 580,000 almost rand. 576,000 rand will the tax be payable if you take your full 2.4 million in cash, right? So how do you save 500,000 rand when you want to retire? You save that 500,000 rand by not resigning and taking your full benefit in cash, because that is what you will lose if you decide to resign from the GEPF and take your full benefit in cash, right? Now, to go a bit deeper into the GEPF, what is the difference between normal retirement and early retirement? And let's look at the same calculation. So we already know the normal retirement benefits, 705,000 rand for this member and a 15,900 rand income for this member. Now, early retirement age is 55. So if Jane decided that she wanted to retire at 55 instead of 60, her lump sum benefit, meaning her once-off gratuity, would be 470,000 rand, 401 rand. Her income benefit would be 10,258 rand. The difference in lump sum is almost 240,000 rand, and the difference in income is almost 6,000 rand. And I show you this because this needs to be discussed and planned. If you decide to go on early retirement, you need to understand the implications, or are you able to provide for yourself and live if you decided to go on early retirement. But there's also more options within the GEPF that I've realized that members do not know of. So the first option that I provided and that I shared with you is the default option. That is, most members seem to go for the default option, but most don't know of the other options that are available. Now, the default option says If you decide to retire, you will get a 705,000 Rand lump sum and an income of 15,900. But you as a GEPF member can also decide to take a reduced lump sum. Meaning instead of your 705,000, you'd decide I want a 614,000. I want a reduced lump sum. Or you can decide you want a reduced income. Instead of 15,900, you decide to have a 15,300. And just to see if everybody is still here, because I don't see any questions or so yet, who would like to know why would you take a lump sum reduction or why would you take an income reduction? Who would like to know whether they take a lump sum or why they should take a income reduction? Thank you, Mr. Samuels. Now, the reason why you would take a reduced lump sum or a reduced income is because you will leave a bigger portion to your spouse, right? So if you decide on the first 50% option, then you will leave your spouse with 50% of your pension at the time of your death, right? So in this case, Jane would leave her spouse with 7,900 Rand. But if she decided to take one of the other options, if she decided to take a reduced lump sum, she would leave her spouse with 11,900 Rand or 11,500 Rand. So that is the reason why you would take a reduced lump sum or reduced income option. And this is option within the GEPF that you are allowed to take. But it's important that what I've written here in the green, you need to register your life partner or spouse with the GEPF as soon as possible. And on another point, this benefit is for spouses only. Sorry, I think my sound cut. So this benefit is for spouses only. For spouses and for life partners, right? It's only for spouses and life partners, but there's a process if you are a life partner. And if you don't have a life partner or a spouse, this benefit falls away. It's important to understand and to know this. So this is a spousal benefit, but it's only for life partners and for spouses. If you don't have a spouse or a life partner, this benefit falls away. It doesn't get paid. Remember at the start, I said that the GEPF is a defined benefit plan. This is part of the benefits that you receive. Part of the benefit is your spouse will have a pension if you pass away before your spouse. But if you don't, that benefit does not exist for you. Now, the life partner application. Now, the GEPF is not allowed to consider, and this I copied straight from the GEPF. The GEPF is not allowed to consider a person as a life partner automatically, even if you have lived with a person for many years. The status of life partner will need to be confirmed should you pass away. This will be done by means of a life partner application. Right? So it's important if you do it now, you will delay any future delays in payments. But the biggest worry, I believe, and you can tell me if I'm wrong in the chat, but the biggest worry of the GEPF members is what happens to my pension when I die. Okay, Peter asked, what if Jane is single? So important question. Thank you, Mr. Swanepoel. So if Jane is single, then nobody will receive a spousal benefit, right? So this won't be received by anybody because Jane Doe does not have either a life partner or a spouse. So if you are single and you pass away, and this benefit, it just does not get paid out. So nothing will happen in this regard. You will lose this benefit put otherwise, right? So if you're single, you lose this benefit. So another question that some of my members have is what happens to my pension when I die? Now, if the pensioner dies within 5 years of retiring, or being discharged, the GEPF will pay the balance of the retirement or discharge annuities to beneficiaries. But I'll show you what this means. There's a lot of words, but in short, it means the GEPF will only pay a lump sum, or let I say an additional lump sum, if you pass away within 5 years of retirement or discharge. So let me show you, and then you'll understand better. So let's look at the 50% option. If Jane Doe died within that first year, Jane Doe is single. Remember, Jane Doe is single. So she does not have a benefit to a spouse or a life partner. So if she passes away within the first year, her children will receive 950,000 Rand. If she passes away in the second year, her children gets less, 763,000 Rand. If she passes away in year 3, it gets even less, 500,000. In year 4, it gets less, 381. And within the last 5 years, it's 190,000 Rand. Important to note, Jane Doe is single, but she passes away 6 or 7 years after retirement. She does not have a spousal benefit, and no lump sum will be paid to her or her kids, right? No lump sum will be paid after 5 years, right? Because, like we said in the beginning, the GEPF is a defined benefit plan, and your benefits are defined, and this is part of your benefits that you receive. If Jane lived to 100, she will receive her pension each and every month, but if she dies after 6 years, her pension will stop, so nobody will receive it because she is single, and they won't pay an extra lump sum to Jane Doe or any of her family members, right? And that is why it's important to register your life partner and your spouse. And the other reason why I placed this this slide here again is just to remind you of, if you don't have a spouse, if you are single, then this will fall away. This you won't receive. Now, this is the biggest worry that I feel, and you can tell me if I'm correct or if I'm wrong. The biggest worry is I don't want to leave my children with nothing, right? I don't want to leave my children with nothing. But there's a solution. There's a solution for this. There's a solution to leave your children with your pension even after 5 years. Now, I've also received a question, and I'm going to touch on tax, but I want to show you how you can leave a legacy to your children and pay 0% tax. Now, this is one of the solutions to ensure that your children have the pension should you pass away even after 10, 20, 30 years. And the solution is, unfortunately, one of the solutions is you need to insure your pension. So say Jane Doe is a non-smoker and she decided on an early age that she wanted to insure her pension for 2.5 million, right? Also, these are just added benefits, but these make them more expensive, but I added them just to this calculation. She also has illness cover, which means if she gets sick, they'll pay out illness cover on this insurance, and she only has to pay until the day that she turns 60. After 60, she doesn't pay anymore. So if she insures her pension, her premium will stop at the age of 60, but she will pay 746 Rand, which means for the 25 years that she's had this insurance, she only paid 223,800 Rand in premiums. And this 2.5 million will pay out tax-free, right? But this is let me say, this is one of the ways where you can ensure that your pension is available to your children at 0% tax. Now, the other options I did not want to discuss tonight because those options are dependent on a person's personal situation. But there are other options that you can use in order to leave your children with pension and to ensure that you don't get, if I can call it, trapped within this GEPF 5-year balance situation. Something else I always get a lot of question on is tax, right? So I want to show you how tax works firstly, and I want to show you how tax works in regards to your cap leave or to leave that is paid out. Now let me get my, can everybody see my spreadsheet? Everybody see the spreadsheet? Thank you. Thank you, Bronwyn. So this formula or these tables are the tax tables for the current year in South Africa. So depending on your income, now SARS taxes you on your annual income, not on your monthly income. SARS needs to see what you earned for a full year, and then you'll be able to know in which bracket that you fall. Right? That I fall in this bracket, which means I'd pay 26% tax. That I fall in this bracket, this. So that is how the tax tables work. If we look at your leave for Jane Doe, she earns approximately, we said 350, 360. This is just for calculation. So she needs to pay tax annually of 74,000 Rand because she earns annually 360,000 Rand. Right? Now, if you and when you receive your cap leave, this is also true for the two-pot withdrawals, right? It's the same principle for two-pot withdrawals. Now, if you receive your cap leave the day that you retire and your cap leave is worth 150,000 Rand, what SARS will do is SARS will add that 150,000 Rand to your 360,000 Rand, which means your total income for that year will be 510,000 Rand. And now they will tax you on your total income of 510,000 Rand, which means you might start off on this table or row in the tax table. And after you've received cap leave or two-pot withdrawal, then you can jump this tax row and you can end up in this row, which means you pay way more tax. Let me open the spreadsheet again. So if we calculate, she paid for the year 74,000 tax. Because she receives a cap leave, she needed to pay 120,000 Rand tax because that is what her earnings was for the year, which means they will deduct 45,000 Rand tax from her leave that she gets paid out. So it's important that not only one does the calculation, but once we plan for this, we can decrease the tax that we pay over to SARS. So you need to pay the tax, but you only need to pay the minimum that you have. You don't have to pay a cent more if you plan your tax and you do your tax planning accordingly. But this is how your leave will work when you retire. Now, the question is, what can we do? How do we solve the problem? And there's two problems that I see. The problem of not leaving anything to my kids or my family, but also the other problem of ensuring you have sufficient income in your retirement years. Now, the solution would be, and I advise you to please speak with someone to just take your situation into account. But for Jane would be, she should retire with the GEPF. She should not resign, firstly. Right? She needs to retire with the GEPF. Why? Because if we go back to our comparisons, the comparisons say that with the GEPF, I have a guaranteed income for life with increases with inflation back to my. When I choose to either take the full benefit in cash, there's a lot of tax. And if I decide to take an insurer, there's a risk involved, right? And Jane is not willing to take the risk because she does not want to lose her capital while she's still living. And she does not want to take into account the market risk. She does not want the market risk, which is anything that is any that can happen. Sorry, and she will lose her medical aid subsidy, leave days, funeral cover. So she wants all these benefits, and she is willing to stay with. Or my advice to her would be to stay with the GPF. Right. So that is the first thing that she needs to do. She shouldn't resign. But she needs to have a proper financial plan in terms of debt, in terms of tax, in terms of that leave that I showed you, two-pot, and so forth. She needs to do that planning because if she doesn't, it can affect her retirement and her current financial situation. The calculation, like I showed you, because she's 60, she's in a bit of a predicament because she did not do that calculation beforehand. So if you do it beforehand, there's certain things you can implement to remove those barriers or those problems. So do the calculation before you make this decision, not at the time that you're 60, then it's too late to implement a lot of the things. Now, there's various ways to ensure that you leave your pension to your kids, but as I said, no solution will be the same, and we need to take everybody's situational or personal situation into account, right? So this is the bulk of my presentation. Let me just ask, did you find this valuable? Do I need to go back to a specific? Let me just see all the questions also, but you are welcome to take me back. I'm going to go through. I'm going to have a question session at the end as well, but let me just check what have been asked. So there doesn't seem to be any questions just yet. So I have created a special offer for everybody who is here tonight and who joined, and it took out this half an hour, almost an hour, to listen to what I have to say. I hope you have found it valuable. I don't see any comments or any questions currently, but I'm willing to provide you with these informations or this information that I showed you within the presentation. So I will be able to provide you with a calculation of your retirement resignation. Because it is a formula that is used, I can do that calculation for you. I'm also willing to create a financial plan for any of you willing and wants to know how to get out of debt fast, how to do their tax planning and leave, and the lump sum and the income portion, and especially the leave, it needs to be done as soon as possible. Also, I can provide you with that retirement plan, how you get to your goal, and also to leave a legacy at the end of the day to your children. But I will be providing it free to the first 5 people. And after the first 5, and I want those first 5 to contact me on WhatsApp or telephonically. But after that, I'll be increasing it for the next 5 and the next 5 and so forth. So if you are interested in understanding your benefits more and what are your options and what would be best for you and how to pay the least amount of tax, then I offer you, because and because webinar, I will offer this special offer to you. I will also make a recording and I will see if I can provide that to everybody who joined. Right? So there's my number. Like you want to contact me. If you want to send me a WhatsApp, there you can contact me. I hope I provided value. Are there any questions? Anybody that missed something, maybe joined late and wants to know more? Valuable. Would you join more of sessions like these? Is there something you don't understand or that I did not touch on that you would like to understand? Maybe I can touch on two-pot system as well, because I know I get a lot of questions on the two-pot. I'm going to give a couple of seconds or a minute or so and wait to see. Let me see. I also have it streaming on YouTube. Maybe there's a question or two. Okay, it doesn't seem like there's any questions. If you do have any personal questions or you want to contact me, let me just end with that slide. You can WhatsApp me on that number. I do appreciate everybody for coming out to listen to my webinar tonight. I think the next session I might do in Afrikaans, see if there is people also interested in understanding or having a session like this in Afrikaans. But if there's no questions, I'm going to say thank you for your time. I really, really do appreciate it. And I hope I could provide you with some value tonight. I hope you understand your pension fund a bit better, and I hope it guides you in making that correct decision. Thank you so much for your time. Thank you, Mr. Swanepoel, Mr. Samuels. Thank you. Thank you for the interaction. I do appreciate everybody. Thank you. Oops.